Welcome to the Gray Report. I'm your host, Spencer Gray. Thank you for being here wherever you are watching or listening today. Every single week on the Gray Report, we break down the latest research reports, articles, data, and trends, all revolving around the multifamily industry, commercial real estate, and the macro economy to try to arm you with some of the best information to make some really well-informed decisions. Again, active, passive, you're in the industry, you're in the right spot. We're going to be breaking into it today. We're going to be talking about what 2026 may have in store for the multifamily industry. We're going to be talking about some national policy. The Trump administration has come out saying that 2026 is going to be a massive year for housing, but we've been hearing the federal government talk about housing policy for years, and nothing's really been done. So is this year going to be any different or more of the same? Also, the development world and multifamily deliveries and starts, we are living through just a huge amount of supply right now in every single market, but those deliveries are starting to slow down, especially in the Midwest, the Northeast. But what does the next couple of years have in store? Are we through it? Are we just in this air pocket right now where supply is low, but it's going to accelerate? It may not be as attractive as some folks have been talking about. And then lastly, I want to talk about loan maturities. We've talked about loan maturities for years here on the Gray Report. All of these multifamily deals that were bought in kind of 2021, 2022 on floating rate bridge loans, well, those loans, they've already come due, but they've been extended sometimes multiple times. And well, the chickens, they gotta come home to roost at some point. At some point there has to be an inflection point and these deals have to be unwound. But we feel like we're a broken record talking about these loan maturities every single year. But now, 2026, there's a massive concentration of these maturing loans, and it could be finally the cause of some real price discovery in the multifamily market. And that's music to our ears at Gray Capital because we're trying to buy deals. We've got investors that want to allocate into the space. We're excited to allocate into multifamily, but there are so few good deals on the market right now. So any increase in inventory would just be so welcome. Thanks for joining us. Make sure you like this video, subscribe to the Gray Capital YouTube channel for all of our videos related to multifamily, property management, investing, and more. Griffin's with us in the seat, co-hosting today once again. Let's get into it. All right, welcome back once again. Griffin joining us in the co-host seat. Welcome to 2026. Happy New Year. How's it going, Griffin?
Happy New Year. Happy New Year to all the listeners and those that are watching. It's been a great 6 days of 2026. We're filming on the 6th of January, and so it's been an eventful 6 days, but seems like an eventful start to what is hopefully an eventful year here in Gray Capital. All positive things.
All positive things. Griffin, I'm curious, before we get into multifamily, before we get into these articles, some of the reports, is there anything that you do, your family, you and Kristen do, kind of the beginning of the year, kind of goal setting, just, whether there's nothing special about, December 31st to January 1st. You can set goals, you could get your house in order at any time during the year. But for so many, it's a great opportunity to, take account of what happened the last year, make plans for the future,
right.
Put it all in perspective. I'm just curious, and I didn't tell Griffin I was going to ask about this at all, so I'm putting him on complete spot, which is the best.
Yeah.
What do you do? What are your thoughts?
My wife is very introspective.
Yeah.
She thrives in moments like this where you get to take a step back, look in the rearview mirror, and see what we did well or what we didn't do well in 25, whether it's for her personally, professionally, or for us as a family. As a sister or a brother, whatever it might be, whatever aspects, categories in your life that you have, she loves to look back and then based on that past year, what can we do differently or what can we build for ourselves or work towards in the coming year? And so she always, on New Year's Eve, will sit down with a piece of paper and run us as a couple and then each of us individually through an exercise of, essentially, what did we excel in 25? What did we fail in 25? What did we learn from both those experiences? And how do you want to take that and move forward into the next 365 days? It has been a new thing in my life since we've been dating and then now we're married. So it's I try to take it rather seriously because I know it matters to her and it's very important to her that I take it on myself personally to try and grow, not only with her but alongside her. And so, yeah, we absolutely do that. One of the things that we've prioritized really in tried to do it in 25, but I'm not sure we did a great job of it. But we seem to give a lot of our time and energy to other people.
Yeah.
We don't give it back to ourselves or reinvest it into our relationship. So in 26, we're just trying to be a little bit more proactive, less reactive, own our own schedule in regards to maybe it's work, maybe it's social scene, maybe it's traveling and family and friends. But more importantly, in our what will be our first full year of marriage, giving our time back to us to then kind of work towards developing a long-lasting, healthy relationship with the potential of some kids in the future.
I was going to say, take all that time for yourselves now before you have kids, because when you have kids, you're like, what time for
Yes.
ourselves? What?
Now, as an individual, and I haven't mentioned this in the office just
Yeah.
yet, but each year, once a year, I try to see what I've got in regards to the mustache growing. And
I've been noticing. I haven't asked you yet,
yeah,
but
it
I see
happens
something.
primarily in the first 2 weeks, 3 weeks of the year. At some point in time, it's going to stick around, but I have yet to really get to a point where I feel comfortable with the way I look. I still don't have it. It's not there yet. I'm in my 34th year of life here, 33rd year of life. Can't grow a mustache, but I'm not going to let it deter me. So there's a couple more days, maybe weeks. I'm going on a fishing trip here with my
There you go.
dad and two brothers, and everybody will show up with a mustache, and mine inevitably is
Okay.
always the worst. So something I do every year is trying to see how I look with a mustache.
Well, the disadvantage that you have is that you're usually very clean shaven. Like unlike me, I'm
Right.
often usually donning a beard, and so when I want to go mustache, it's just addition through subtraction. I shave the rest of the beard off. I can don the mustache for a couple of days, then I can just delete it and go back blank slate. But for you got to grow the stash from the ground floor, which you have to go through that awkward transition period
Yep.
of kind of the stubble, and it's a rough go, but the genetics haven't passed through to you because you're getting together with family. So you missed out on the. I think you would look good with a stash.
If it was a good stash,
I think it would be.
The problem
it'd
is
be
it's
fitting.
not.
How long do you give yourself?
So I've got about 3 weeks
not
this
enough
year,
time.
and it's not enough time. I my stepdad, who I'm going on a fishing trip with, he left town and he went down to Florida. He's gonna be down there until we go fishing.
Is he down there now?
Yeah, he's got an incredible mustache, and so I was like, shoot, he's got a nice head start. I got to get going. It'll come off immediately after that trip, if not in the midst of that trip. I just can't show up
without at least making an attempt.
with the scalp.
Have you considered any serums or anything really to help you along?
Yeah, this
give
is all
kickstart?
natural.
Yeah.
There's nothing wrong with with using some performance enhancing
Yeah,
hair
I
growth
don't- I
products.
mean-
However, I will say that this has been an annual thing, and my wife Kristen, she's on board with it. She would prefer me to grow out the full beard, but that's even more embarrassing.
She would prefer you to go with full beard.
Yes, yeah. She likes the beard of the stubble. For
Yeah.
me, it's a more of a respect thing passed down from my grandfather
Yeah,
to be clean
yeah,
shaven,
yeah.
present yourself in that clean fashion. So, there's a potential as we just lost him this year that maybe I show up with a little bit of disrespect on my face and try to grow a full beard or a mustache. But for the Gray Report, this is good news. If you're a listener, you just turned into a viewer. Because I know you want to see.
Well, and we'll have to post the link down in the comments. But I don a mustache for a good month and a half, 2 months.
Yep.
I think
You did.
2024.
See,
Let's go back to the archives.
You've got the talent. You've got the capability to do it. And for somebody that's a little lackluster on the talent and the capability, it's tough to walk in the door into a room full of serious people. But I do it anyways, just to see what I got. And it's obviously 2026 is maybe not my year, but looking forward to 27.
Yeah.
The mustache in 27.
Well, outside of mustaches, it's going to be an interesting year, not just for facial hair, but for multifamily.
Right.
We've talked about, we're in this air pocket of supply. Supply's really dropped down, especially not in every market. And again, there's a Sunbelt versus everywhere else kind of conversation. Like in the Midwest where we're seeing supply come down, like Indianapolis. I mean, it's a fraction of where it was last year, which is a lot of relief because rent growth has slowed down. Vacancy is pretty high right now. There's other issues that are going on which I haven't seen talked about that much. But collections are becoming much more of a challenge. The consumer is being squeezed. So not everything is rosy right now in the multifamily market. Even we've said it's kind of darkest before the dawn, perhaps. But there is some relief coming from less supply coming online. Any other themes? We put out this research report, the Midwest Multifamily Forecast, which you can download. Go to the Great Capital website, and there's a button right there to download it. Any of the other themes that since we put out the forecast, whether it's loan maturities, whether it's supply, any other themes that have really kind of come to mind that are sticking around, or anything that you've kind of maybe changed your mind on? We were talking the end of last year, and any new information that said, I kind of was prioritizing, this thought, but now I'm really focused on I think data centers are all going to burn up and go to zero, or
Right.
what any hot takes or developments kind of since we put out the Midwest Multifamily Forecast.
Right. I think just as a part of the research involved in putting that forecast together, and then kind of the matriculation of the report to its readers, we did the webinar, and then I'm putting the newsletter together. The thing that I think I've seen that's maybe a little bit kind of against my expectations is the amount of capital that seems to be kind of pouring back into CRE currently.
Yeah.
Or maybe this posturing to pour back into CRE.
Yeah, that's a good way to put it.
The past year in all of our equity raises, and just talking to folks that are fundraising and raising capital, it seems to be that there are some headwinds involved, and just the high level of uncertainty that has kept people on the sidelines, or kept people's powder dry, while there's still I would say a significant level of uncertainty as we move into 26. It just becomes interesting, as I've seen a lot of these, reports, surveys, data points that indicate that institutions and family offices, RIAs, different allocators are looking to put their dry powder into commercial real estate assets, not just multifamily, but you mentioned data centers. I've seen a kind of a resurgence in the appetite for retail.
Yeah.
As some of the returns relative to the risk have become more palatable. There's a lot of people that are now kind of back and interested in the office sector. As people kind of return back to the office. The prices, the asset values on offices have become, I think, of interest and great entry point. And so there's just this, I would say, a buildup of momentum in regards to capital allocations into CRE that otherwise I was not expecting as we ended last year.
And it seems like a lot of this interest is first being led by the family offices, which is, I think, a little
Sure.
and some institutions, obviously, like Blackstone and KKR. They made some big moves last year, kind of kicking things off. And I think that was a kind of an all clear sign that wasn't fully absorbed by the entire market, because it seems like it was the very top end of institutions, the largest institutions that gave that all clear. All of the institutions that seem to be kind of, and I use the term institution kind of broadly, but really sophisticated institutional private equity it's allocating to real estate, they all kind of seem to stay on the sidelines, or still preferring kind of the private credit space, a little bit more safer, using air quotes, position in the capital stack, where the common equity was really dried up. But the family offices, in this last year especially, we saw really re-enter the market in a very strong way, where some of that institutional capital is, I think what you put it the right way, really positioning themselves or posturing themselves to make larger allocations. There have been some surveys that have come out recently that have indicated that most groups are planning on to increase their allocation to CRE next year, and assuming then the subsequent years. So everyone's ready to get back into it. I wonder how much liquidity events need to take place, because there's also, while everyone wants to go and buy real estate, there's all of this real estate that was bought previously in older vintages. Whether that was the last couple of years or even 5-7 years ago, where folks they're waiting for the opportunity to cycle out of those deals to then go to do new deals. I mean, we have some assets in our portfolio that we don't need to sell, because we don't have a maturity coming up, but they're assets that that we've either we have a ton of equity in, and it'd be a great opportunity to go full cycle on some, but we don't want to sell at the wrong time when, in a year from now, we feel like there may be a better environment to sell. Cap rates may be slightly compressed, or maybe we're going to get a little bit more rent growth, or maybe a prepayment penalty is going to be burned off, or there's some other assets of where, we've said, hey, this is going all right, but we want to prune the portfolio. This asset is taking a disproportionate amount of our time to manage, and we think that there could be better opportunities elsewhere, but we don't want to sell it now when, again, in a year we think there's going to be a better opportunity. So we're seeing a lot of people saying one thing and then doing the other.
Yeah.
Same thing with consumer sentiment. It's almost the opposite, actually. Everyone's saying that they're really worried about the economy and that we're going to go into a recession and everything is horrible and AI is, bringing into the end of the world. Yeah. But we're spending a lot of money still, and the economy is still like chugging along. It's almost like the inverse of that. But it's fascinating. What concerns you about 2026? We've talked about, what the, kind of getting through this muddy middle into the promised land. What really worries you? That whether it's multifamily related or even macroeconomy.
Yeah, I think it's in both. Is this the ever increasing rise of expenses kind of across the board? I've noticed in my personal life. I've noticed it here in our portfolio. How much expense growth can we currently handle with some of the supply pressure and some slower accelerating or flat rent growth? Is a little bit concerning to me. I'm watching. Some family members of mine, I'm watching friends of mine having kids, trying to figure out, where they can put their income in order to, fund their life. And, I started to think about some of the tenants at our properties. And like you mentioned, delinquencies are ticking up. And is that due to, other objects or other, services and goods in their life becoming more and more expensive? How is that going to impact, the overall multifamily industry? We've seen, I would say, some slower rent growth here in the Midwest. We've seen negative rent growth across the nation, but we've also seen rising expenses in regards, to the goods and services as well as just overall insurance. It's just a math equation that if it persists, it doesn't end up with a very positive story for our business and for our investors. And so that would be maybe my main concern is this ever increasing. I don't know if it's the inflation that we're reading about, kind of constantly, but we saw in the last CPI, it actually kind of drew back. And so I just don't understand maybe necessarily why a Chipotle bowl is costing me $20 these days, and maybe it's $17. But in high school you've
got the red chimichurri and the guac.
Well, that's true. I'm getting the extra stuff, but it seems like things are a little bit expensive these days.
No,
it's concerning to me personally, but also in our business world, it's also creating concerns.
It is. Well, and again, it's our portfolio. It's most portfolios of where just the OpEx has just ballooned and has broken a lot of budgets. The question is, how much of that will continue? How much it is? Are we going to see continued high year-over-year growth rates, or have we seen the bulk of that growth and inflation is in the rearview mirror, and we're just kind of dealing with it, and now we have to have the revenue kind of catch up a little bit, which is a little bit delayed.
It was interesting. This is again kind of a personal anecdotal story, but we had some family in town from LA for the Christmas holiday, and we took them out to dinner. We had party at 10, we had party at 4. We were just entertaining, and you could kind of see the look on their face of like, what this dinner for people only amounted to this dollar amount, where in LA, they might go out to dinner for 2 and it's that same amount. And so they were just, and they're from here, born and raised in Indiana. It's just like they just kind of forgot the relative affordability of living in the Midwest relative to Los Angeles specifically. But it's a nice reminder that while I think things are ever growing in expense, that there are people that live in markets where the affordability is
it's
much more drastic. Yeah, correct.
Jay, our chief investment officer, made a comment to me today. And it was on the same topic of reducing expenses, and everyone's kind of tightening the belt a little bit because you kind of have to to make it all work. Jay said, "Hey, you notice we didn't get nearly as many gifts to the office, like kind of corporate gifts, end of the year, little fruit basket, candies, cookies in previous." And I don't think it's because people don't like us anymore. But in previous years, it would just the whole table up at the in the main area of the office would be filled up with,
Right.
with gifts and stuff.
If you didn't send us a gift this year, it's not too late. We're still receiving.
Yeah. We're always yeah. But this year it was
point.
light.
Yeah,
And
it's a good
I hadn't
observation.
really thought about that. And again, we still got stuff, and we were it was awesome. Thank you, everybody. And you don't need to send us anything.
No.
But again, it was just another anecdote of, and we even changed our strategy because we were looking at what we were going to send. In previous years, we've sent like really, big, or not big, but we've sent these gifts to our investors, and we were looking at what that was going to cost us. Another $25,000, and we were like, well, I don't know if is that the best use of our money right now. Do we spend $25K on sending? And in this case, we were like, because we have more investors. Every deal we do, we add more investors, which is awesome.
Yeah.
And we were going to get everybody, like a local cookie, thing.
Yeah, it was going to be a nice idea.
We were like, these are good cookies. This will be nice. On a per investor basis, it seemed reasonable. But then times all of our investors, it was like $25,000.
Yeah.
For like 6 cookies. I'm like, $25,000 for 6 cookies.
It was a little steep, and it also just the math was not making much sense in these times.
And we figured if we weren't going to send something like really kind of substantial,
Yeah.
it's more of like the thought that counts. Hey, we're thinking of you. We want to wish you, happy holidays, Merry Christmas, Happy New Year. So we decided to send a card.
Right.
I still think that was the right decision. I think that at the end of the day, in an environment where, again, commercial real estate, most companies with great capital, included, a large portion of our revenue is transaction based. So if we're either, we make, the most of our money when we sell an asset, we do a good job, we manage it well.
Yeah.
But we also, the way that we pay a lot of our salaries and keep the lights on is through deal fees. It's not money that we pocket. It goes to it's going to pay everybody's salaries and all the operating costs.
Right.
And we've positioned ourselves with our property management company, everything else we do, to where we're not absolutely reliant on those deal fees. Like we could go a year without doing a deal, and we'd be fine. And we're almost to a point of where we can do no deals and be fine. But, doing less deals, as the entire industry has done less deals, volumes are way down. We'd like to do, 3 or 4 deals a year. Did 1 deal last year. And the reality is, I'd rather need that money to, bring on the next person. I'd rather give, honestly, the team, or people that have been moving the needle for the company, rather, bonus them rather than send investors cookies.
Right.
Right. Not
6 cookies.
And I think our investors would want that also. It's like, take care of what's important.
Right.
Save the cookies, and then we're going to invite you in India. We'll make you cookies.
Make sure
take you out to dinner.
make sure your house is clean before you send me a gift.
Do all that other
make sure
stuff.
you can run your show before.
Yeah.
Yeah, I think that makes a lot of sense, especially if stewards of capital, other people's money.
Yeah.
You need to be making decisions, investment decisions, whether it's at our properties or at the corporate entity, that makes the most sense and puts the company in a position to succeed. So, like you said, it's the thought that counts. I don't think we burned any bridges by not sending cookies this year.
Yeah, I think so. I mean, maybe it's cheap, but I think, again, I don't think
We were talking about rising expenses, and that was a controllable expense that at the end of the day, I think the correct decision was made. So,
Yeah. All right. So we talked a little bit about deliveries. Globe Street, they do have this piece out here. I'll just pull it up. Developers see early signs of multifamily construction bottoming out. It says, multifamily starts are relatively unchanged over the past 3 months, marking a potential pause in the sharp pullback that has defined the sector in the past 3 years. A quote from NMHC chief economist Chris Bruin. He said, starts have pulled back drastically over the past 2 years amidst high interest rates and slowing rent growth. Yet, builders and developers are currently reporting lower costs for construction materials and labor and have expressed optimism about their long-term prospects. So, what this seems to me is that, that pendulum has swung of where, on at what period of time where, labor, lumber, electrical components, everything was so expensive. It was costing so much money to build these assets. And then things were still expensive. And then interest rates came up and the math didn't work. I don't think the math completely works yet, but listening to what Chris Bruin is saying is that we're moving in the direction of rate relief. We're not there yet, but things are better than they were, at least from the Fed funds rate and so forth, than we were, a couple months ago. Mm-hmm. Costs are also coming down. It's not fixing the problem, but we're moving in the right direction of where we can start adding more supply. But also, the reality, and this is not what Chris is saying, is that we are seeing developers get back into it and push projects forward. And whether that they're projecting some of these lower rates at the takeout, which may be a little bit speculative, or they're just looking at it and saying, look, I want to be the only one delivering in 2 years when no one else is delivering. And the picture that it's painting is we're going to see a return to normal supply, pre-COVID, even slightly above pre-COVID levels of supply here probably in the next year and a half or 2 years. And for the Midwest and Northeast, I think that that's just going to be kind of return to stability. The question is on some of these high supply markets that aren't really experiencing the supply relief, are we not looking at, 1 or 2 years of negative rent growth, but is it essentially, flat rent growth for the next 5 years? And how does one underwrite the acquisitions of those types of assets, in a Dallas or an Austin? Because you can say you're getting at a great basis. Like I've seen a lot of people, post on LinkedIn say, I'm getting this multifamily deal at an incredible basis, 20, 30% below what it traded for at the peak. Mm-hmm. But that's great. But what is that? Doesn't really matter if it doesn't cash flow, and you can't, if you can't actually project, revenue growth when there is expense growth. Mm-hmm. Again, that math doesn't work, and so it requires a pretty massive additional price correction than we've seen today, at least in the Sun Belt, which is crazy to think about.
That is crazy, and the basis, argument. It's interesting because you might be getting at a good basement relative to the peak, but where are we in this, downturn or this trough? And, how long will it take to kind of come back on that rise? And so, like you said, some of the fundamentals or the growth metrics in a market that otherwise is oversupplied and will continue to kind of be saturated, how long does it take to get back to, an advantageous disposition point to where that basis is actually, tangible, fantastic entry point? Because it's a fantastic entry point based on the past, but in the future, how long will it take us to get back to that?
At the end, we debate internally sometimes. Jay and I we'll go back and forth on. We talk about basis, and a lot of times it revolves around when we look at one of our own pro formas. A 10-year projection and the price per unit sale price in year 10, and sometimes Jay will be like, that just seems like I can't stomach that per unit price that we're exiting at. He's like, is anyone going to buy it for that? I'm like, well, it's not today, but 10 years of growth, perhaps when you go back 10 years and look at where we were buying assets for at that time. I mean, we could pick up, value add deals for sub 50K a unit. Around 50K a unit was like, a good buy. But these were, properties they were stabilized, but you have to go in, do a value add. But now, if we can get something for $100,000, it's typically looking like a good deal, maybe 75. Mm-hmm. And so, that's essentially, 50 to 100, it's a doubling of that per unit price in less than a 10-year period or about a 10-year period. Yeah. So to say, so to talk about a $400,000 per unit deal in the Midwest seems a little outlandish today, but 10 years from now, where going from 200 to 400 may not be that outlandish. So long story short, it's all relative, and the price per unit, it only matters so much. What matters is how much cash flow is that asset producing
along the way.
And that's just kind of the bottom line. If it's not producing adequate cash flow to produce a return that adjusts for the risk associated with it, the basis doesn't really matter.
Basis doesn't matter at all. I thought the paragraph just below the one that you shared, just another lower percentages, but other reasons as to why firms are reporting that the starts have declined, just economic feasibility, lower rent growth, broader economic uncertainty, and just the availability or cost of construction financing, just other barriers to entry in regards to putting a shovel in the ground.
Yeah. I mean, it's definitely, and it's good news for, I mean, the U.S. in the housing market. I mean, we need new supply, but I think it's just a reminder that that the recovery, again, especially in the Sun Belt, but probably nationally, is going to take a little bit longer than most folks would want. And then again, coming back to the topic of these loan maturities, and this year, when a bank goes to an owner and saying, "Hey, look, the loan's due. We need the money back." In the last couple of years, the owners were saying, "Well, rates are going to come down, and cap rates are going to come down, and rents are going to reaccelerate because supply is coming off a cliff."
Yeah.
Like all of three of those arguments now, are relatively mute. I mean, even rent growth. I mean, you can say, "Hey, we might have okay rent growth. We might have 2% rent growth this year, 3%. Maybe by 2027, 2028, we'll be like really reaccelerating." But again, that's a whole other extension. For someone
Right.
that's already done multiple 1 or 2 year extensions, these short-term bridge loans have turned into long-term
Yeah,
permanent
sure.
but not permanent loans. And it gets us back to this moral hazard that we've talked a lot about, of like, well, what's the point of any kind of maturity date or term limit if they just keep getting extended, and,
Yeah.
and what kind of precedent does that set?
Should we jump to the how does this end? Mark Belsky post just on that note.
Yeah, I saw this post that Mark Belsky, who is a primarily an equity broker based out of New York City, does a lot of equity, but also a lot of pref equity. Was doing mostly JV equity until a lot of that common equity, that JV equity kind of moved down the capital stack into pref. Talking to Mark, that's the vast majority of what they have done. But Mark sees a lot of deals, sees a lot of, as you can imagine, doing a lot of pref. He gets a lot of deals brought to him that are like, "Hey, we need this essentially rescue capital." He's looked at a lot of different capital stacks. They've done billion. I'll let Mark sell his own book, but they've done billions of dollars worth of financing. And I just thought this was a very just not a take that didn't really pull any punches. And it says, how does this end? The more I think about it, the fewer ways I see for this to work. In today's market, specifically multifamily senior lenders, they want to lend at 8% minimum debt yields, prefs at 7+. There's some in 6.5 but some at 6, but generally those are outliers. He's looked at hundreds of refinances, pref equity requests, and he's basically saying the data is hard to ignore. So there's this 2026 maturity wall, which again we've reported on for years now. Extensions over the last 18 months have pushed nearly $1 trillion of debt into 2026, roughly 3 times the average, according to Mark. The yield gap, he said, "I have yet to see a refinance where the existing senior loan was written at an 8% debt yield. This sub 6% reality is a growing number of loans sitting at sub 6%. Many are at 5, some are under 4, and the deals, they just don't work. They do not work, even with preferred equity layered in. Just they're underwater. They're not, the loans never thought about this way, but extensions and modest paydowns have bought some time, but not solvency." Okay, so we bought the time, but it hasn't fixed anything.
Yeah.
If these loans, I think, and this is what stayed with me, this quote. "If these loans could have been refinanced or paid off, they would have been by now. They just would have been." And so I won't read the rest of it, but it's he ends up with, so how does this end? What happens? There's all these zombie deals, and is this going to be the year that these deals are unlocked, unleashing more volume? The whole idea is that this is supposed to be kind of a controlled burn, kind of flattening the curve of maturity, so you don't have all of these maturities happen at the same time. You get them all worked out. This is cash injection over here, preferred equity over there, maybe a foreclosure in a certain situation over there. But man, is 2026 going to be the year, or is it's more the same?
I was getting ready to ask you the same question. Just below there, he says, "As time passes, the number of viable exits appear to be shrinking." So how much more time can pass before a lot of these opportunities, in our opinion, kind of come to fruition? As buyers of multifamily asset class, there's some true price discovery here that could be super advantageous, not only to our equity partners, but to the general partnership of Gray Capital. We're not hoping for massive losers, but at the end of the day, in our economy, there must be winners, there must be losers for, I think our world to work. And so I take a look at this situation, like you said, we've been tracking it for years, and it seems like in this environment right now, everybody is winning.
Yeah.
And how long can that persist? How long can everybody, kind of be winning, and how long can this blind eye be turned? And how long can we prolong this problem that's inevitably going to come to a head? So we were just talking in your office earlier about, what does it look like if some of these opportunities do come to fruition? And will it trigger this, kind of cascading economic downturn?
Yeah.
We were just talking about capital on the sidelines early in the podcast, and how there's got to be essentially a price floor, because there is so much deployable capital looking to go into the multifamily or commercial real estate sector. So will it really drag CRE down as much as maybe some economists may think?
Yeah, and I think it's a good point that there probably is a floor, in that it's not that things are going to fall out. And so, like, the question is there room for maybe some slight cap rate expansion, in 2026, and how much? Or is it no, things are you're going to be fully priced because there's so much capital that's out there.
Right.
I think it all depends on the volume of deals that come out and what does get worked out behind the scenes, which that's been the mechanism that how these deals have been being worked out. The ones that have the good enough deals that have had their capital stacks fixed over the last couple of years, it's mostly been behind closed doors. It's not like a public announcement of, like, we have a problem and we're going through a process. We need help. They figured it out, and they made a nice announcement that they did a restructuring or recapitalization or refinance, and they're not announcing to the world that we had to do a $10 million cash and refinance, and the IRR is going to be 1%.
Right. We've done some research kind of into this loan maturity. We've produced the 2 reports.
Yeah.
We've done some consultations with Gray Capital Limited Partners in regards to other projects that they're in, or that have issued capital calls, and we've tried to place pref equity in the last 3 years. We've seen a small number of some of these deals, and I'm sure Mark has seen just a much larger number. I would love to see some of those deals that he's been floated in regards to pref equity, because the ones that we were seeing were really of disinterest to us and our equity partners. Most of them seemed like, I don't want to say throwing good money after bad, but they truly seemed like a lost cause, or just an incredibly unpalatable risk relative to our business model. And I'm uncertain as to who's going to come in and try to save those deals, or offer them a price at which is at par, or wouldn't be that equity, or those operators taking a haircut.
Yeah, the good good is kind of relative depending on who you are, but
sure.
Yeah. Positive. The silver lining is a lot of the valuation reset. It's not as though, like, the banks are going to be taking that big of a loss. Typically, the declines go basically to where the senior debt is, plus or minus.
Sure.
And in some cases, investors can get a portion of their capital back. It's just that most of that common equity has gone to zero, and it's at what point are these investors going to capitulate, acknowledge that, realize that's reality. I think more and more every single day, in their mind, have put some of these investments, they've marked it to a zero.
Yeah.
I mean, I know some people, they're like, any alternative, they put it over there, and I'm just going to kind of forget about it for a while.
Right.
I not think it's gone to zero. You're hoping that it at least is worth what you've invested.
Sure.
But I think more and more investors in their mind are probably marking some of these investments down to a zero. And if they are able to recover any, they're excited.
That's a positive. And there's, the folks that have gotten, have become secondary to pref equity, the common equity that just sits there. I mean, there's minimal hope for some optimism there.
Do you think it's going to be, has it been difficult, and do you think it will continue to be difficult to raise capital from either retail, family office, institutional investors who have experienced these capital calls, they've invested into multifamily, and they've lost their investment? Do you think that will those investors ever invest in multifamily again? Are they gonna? What do you think?
I would hope that they're not, so disgusted and turned away from the asset class based off that experience. But it definitely is another layer of trust that we need to blanket onto them or earn. And I think that at Great Capital, sure, I think certainly when you talk to somebody that's going through a capital call or taking a loss or a discount on their equity based off of prior investments, anytime you're trying to get somebody to, jump back in, it's going to be more difficult. But I think that at Gray Capital, we've got a great track record. We've got a great team. It might be a little bit easier relative to other firms, but I do think that it's going to take a little bit more patience, a little bit more time, a little bit more customer service in regards to getting people to actually make an allocation than somebody that otherwise has not been through that capital call experience or have seen their equity dollars get erased.
Yeah,
which is really kind of disheartening to myself and Blake as we sit in investor meetings and calls and pitch a deal and run through our track record, run through our expertise, run through our team. And at the end of the day, they've just been so burned or they're so scarred from that past experience that really we may not be able to get them back. It's going to be 100% on them to come to a level of comfort with the risk that's inherent to real assets.
Get through a couple of years of therapy and come back around.
Possibly. Yeah. I you know what? I think this is a great medium that we're offering for folks that are, looking to generate trust with a sponsor, looking to get inside the mind of a CEO, the guy that's legitimately behind all the levers pulling, making decisions. I think that if you're not offering a podcast as a firm, you definitely should with your decision maker front and center, just so people that otherwise have been burned or lack trust can start to generate a base layer of trust. So when they do jump on that first meeting, whether it's with myself, yourself, or Blake, they know who they're talking to.
Yeah. No, it's been very beneficial for us, for sure. I'm just thinking, hearing you speak, before the last couple of years, you talk to investors. There was a common narrative that was definitely false that, that's like, none of these deals ever really fail. People could point to the default rate of agency debt of, fraction of percent. It's like these deals just like, they don't fail. You don't lose money on these deals.
Right.
A lot of people have learned that that's not necessarily the case. I also think that it is a great opportunity to understand the nuance between different deals and different strategies and the different risk profiles. We talk a lot about opportunistic and value add and core plus and core. And people throw those around just as in like, it's the strategy, it's the type of deal, or it's how new, but there's less emphasis, not enough emphasis there should be on the type of risk that you're taking, which really that's what all that is about, is how much risk that you were taking. Because there is a huge difference between a distressed, opportunistic deal in, let's say today, like in Austin or Phoenix, versus a core plus deal in Columbus, Ohio. There's a big difference. And there's a difference between the same value add deal, the same property, and someone who's going to go in with a short-term bridge loan that's on a 2-year term, floating rate debt, versus something that is primarily, the value add work is capitalized through actual cash. There's a fixed rate loan put in place, it's a long-term debt.
7-year hold period.
7-year hold period.
Yeah.
Now the bridge loan deal may show a much higher IRR versus the fixed rate long-term deal, but it's because that higher rate of return has risk baked into it. You're taking on a significant amount of risk.
Yeah.
And if investors could have one takeaway from all of this, is that risk matters, risk mitigation matters, and strategy and execution matters. Not just on the ability to execute the strategy, but what is the underlying strategy that you're even pursuing? And it's not just, I'm investing in this apartment in this market. I'm generally investing in multifamily, which I think a lot of investors paint with a broad brush of, I'm investing in multifamily, some value add, some core plus, it's all kind of the same. And the Sun Belt seems like a good place to do it. If anything, this year is the year for, like rifle shots, being very selective of the assets, the markets that you're going into, and understanding, is this the right strategy for today, especially if you're concerned with, where the world's going and there's uncertain. You acknowledge that, we can't predict the future.
Yeah.
But all right, so let's remove some of the variables and maybe take a little bit less risk, but not take all the risk off the table.
Yeah, I saw a great LinkedIn post. I wish I remember who it was, but said, 2026 is going to be about having a believable, compelling, and achievable business strategy
Yeah.
in the multifamily space.
Yeah.
Which I think there's obviously different buckets of risks that I think LP should be not only aware of but well versed in. And you asked me the previous question of folks that are scarred or have a unpleasant experience based on capital calls or loss of equity, or you asked me if it was retail, family office, institutional, and I'm just kind of rehashing some of the conversations I've had in the past 3 years with LPs. We have conversations with sophisticated institutional investors. We also have conversations with first-time retail allocators and investors. So many times when we get into some of these, lesser sophisticated conversations, primarily in the retail space, there's not a lot of inquiry into the capital stack and where does my money sit in the capital stack. And as you look and read about people placing preferred equity into deals, people are taking out mezzanine, debt or junior notes, just trying to give retail LPs or just any LP in general a really good, picture of those risk buckets. And one of them being, where are you in that capital stack based on any kind of preferred payments and senior debt or mezzanine debt, preferred equity, and understanding the mechanism and the mechanics of that cash flow distribution and any kind of upside proceeds, moving forward. I don't think there's a lot of retail LPs that understand the capital stack and how it works.
No. Yeah, no, there is a lack of understanding of really how the capital stack, how it flows.
Right.
And I know that evidence, and again, this is on one end of the spectrum. On the less sophisticated spectrum, most of our LPs are, like, I'd say, much more sophisticated than your average multifamily investor, and especially in the family offices and institutions that we work with. But some examples of questions of lack of understanding of the capital stack is, and I haven't heard this in a couple of years, but being asked, well, what is my money being used for specifically?
Right.
And is it being used for the renovations? Is it going into the down payment?
Mm-hmm.
Is it what is my $100,000 like? Are you putting? Is that going to buy the paint?
Right.
And obviously it doesn't work. It doesn't work. Like that. All the funds come in, and you're a percentage owner of the company that owns the property itself, and we aggregate all of the capital together. All of it's sources and uses. We have all our sources of funds,
Mm-hmm.
some of which is the debt, some of which is the equity. And, if we had preferred equity, that would be a source also, or whatever. And then this is what you're going to do with the money. You go for the down payment for the purchase price of the property itself. We've got to fund, CapEx accounts. We've got to pay for, title, insurance, and all the stuff that it goes towards, and it's all broken down. But the lack of understanding of, those what are all of those sources, mm-hmm. and not just, what your money is going used to, but like how is it categorized and how is it treated, and what are your rights, and what are the the orders of cash flow and the priority, and never assume that this deal looks pretty close to this other deal that I participated in, and I'm just going to assume that the waterfall is the same and it does what it does because they're all the same. Oh, it's a 70-30 split, it's an 80-20 split, there's
mm-hmm.
an 8% preferred return. It doesn't stop there. There's a lot more nuance into specifically how the language in that operating agreement is specifically spelled out.
Yeah.
And most people don't go into that detail.
Investigate the economic structure.
Yeah.
Of the deal, because that's very important.
And I think the key is, the superpower that LPs have now is, these PPMs, operating agreements, they're dense. There's things that could be hidden in there. ChatGPT, or if you feel comfortable, dropping these operating agreements into an LLM, you're not sharing it around too much, but you can drop these PPM operating agreement in and ask it any question and get down to exactly, tell me how the cash flow works. What is the order of priority?
Right.
What is the waterfall? What are my rights as an LP? What can the GP do without my consent? I think most people would be surprised. Because a lot of times the GP can do a lot because they need their ability to do a lot to run the deal. Mm-hmm. But is it, can they also start a new business.
Right.
What else can they do?
What other buckets of risk does that open up to the LP? And ChatGPT has been a really awesome resource just for me as we go through an acquisition and go through a capital raise. I'll put our own PPM and operating agreement in there and just make sure that my understanding of it is valid and 100% up to speed before I go into the meeting. And then there's a lot going on in some of those operating agreements and PPMs and the fee structures and the capital stack, and there's just a lot of components in an alternative investment structure that needs to be considered. I'll be in the middle of a meeting, and sometimes we'll have to jump back into ChatGPT and ask in the operating agreement what happens if this, or kind of an if-then statement.
Sometimes the section in the article, but other times it's I know it's in here, but okay, I forget the exact page, the exact section, and let's pull up the actual language. And to avoid a second meeting, or I'll email it to you, it's nice to be able to actually pull it up.
Nice to be able to pull it up and just be certain. So, I think just the buckets of risk need to be better understood or better communicated from managers, sponsors to an LP, specifically the retail LPs that otherwise are, maybe not aware, as well educated as they should be. So
I understand what you're getting yourself into, especially more and more. There's all these different classes of equity, which can be great tools, good opportunities. It can be smart tools that GPs use to raise capital, gives LPs different rights, depending on your strategy or priorities. But make sure you know what you're signing up for, where you are in the waterfall. If you're prioritized, deprioritize, what are your rights? Are you limited? Again, because if it sounds too good to be true, there probably is some sort of catch. There's no free lunch. All right, just quick gear shift. Trump promises aggressive housing reforms in 2026. Here's what we know so far. Again, man, we throughout all of the Biden administration, we talked about on the Gray Report quite a few times. The Biden administration would put out these memos on housing, and they're like, this is what we want to do on housing. And it was all kind of the same stuff. It wasn't over regulatory. It wasn't calling for rent control. It was calling for deregulation. Simplifying business. Building codes. And so what I'm trying to get at is more talk about housing reforms in 2026, but is 2026 the year where we see action? This has certainly been a year so far where there's been a lot of action from the Trump administration. I mean, we made quite a surprise entrance into Venezuela this last weekend. Is in the same, you would like that a lot of coordination, a lot of effort, a lot of money spent going into Venezuela. Sounds great. How about the housing market? Are we going to see a similar amount of action, looking back at home a little bit, as opposed to going to a foreign country? You think, is this the year that anything happens, or is this just placating because there's all this talk on affordability? They're trying to assert, the Democrats obviously are talking about affordability, housing and health care. Mm-hmm. Is the Trump administration trying to get in front of it and basically say, hey, we're going to own affordability but are they actually going to do anything?
They're seemingly quick to act. This Venezuela development this past weekend, they've got, they're in Minnesota currently trying to kind of dig through a lot of the fraud that is apparently rampant in the child care sector within Minnesota and potentially Ohio, I read the other day. But it seems like they're quick to act, but it seems like they potentially have some higher priorities comparative to the housing market, even though it's been in the discussion for a long time. And in this article, there's a quote that says, mortgage payments will be coming down even farther. Trump said, early in the new year, you will see this. I will announce some of the most aggressive housing reform plans in American history. So it's on his radar. He's made a promise that early in the year, he's going to announce some aggressive plans. Just curious how early in the year.
Now, the big, there's all kinds of proposals, but 50-year mortgage, all now. We've talked about that. But the biggest thing that could impact multifamily sector, and if they can do it through what mechanism is debatable. But again, its impact on the 10-year Treasury. Trump, again, we all know, obviously a real estate guy, understands the 10-year Treasury. How important benchmark rate that is across finance, but especially real estate. The 30-year mortgage is not tied to the Fed funds rate. It's much more closely tied to the 10-year Treasury rate, and same with a lot of commercial mortgages. So if we can get the the 10-year Treasury rate down to closer to 3.5%, then all of a sudden there's a pretty nice spread between cap rates and interest rates. We unlock a lot of this liquidity. Again, can we get some positive leverage, and the math starts making sense. And it's not just real estate. It's private equity. It's how all these things are financed. Real estate isn't in a vacuum. It's all types of assets the way that they're financed. And so I think that in their mind, it's beyond housing. It's how do we unclog the financial system by getting the U.S. 10-year Treasury lower, but no one really controls the yield of U.S. 10-year Treasury bonds. The market does. There are concepts called like yield curve control, like that Japan has implemented, and it's been talked about in the United States, of where the Federal Reserve can influence the yield of the 10-year Treasury by buying or selling 10-year Treasury bonds.
Sure.
But it's more intervention in the economy. It's another form of what the Federal rate does is basically fixing the price of money. They do that by setting and fixing the short-term rate. You think they're going to do anything with the 10-year Treasury? Are we going to see some yield curve control? We're already. Obviously the administration is not bound by ideology or campaign promises, of non-intervention. So, we're taking stakes of companies. Why not, notch that 10-year Treasury down to 3.5? Just peg it for a while and see what happens. Obviously, there's all kinds of unintended consequences by doing that, but is that where we're going?
The president's going to get to name his Fed chair, or nominate his Fed chair, and so who knows what kind of mandate that individual will have, and how he will proceed in his tenure. But I don't know how I feel about big government intervention into things that otherwise they're.
Doesn't matter how you feel about it. Is it going to happen?
Shouldn't be meddling in. Honestly, if we can get the 10-year to 3.5%, which is the number you threw out earlier, I think everybody would be happy. And so if we can get there, that would be quite incredible for a lot of people in a lot of different industries.
Yeah, so it would be.
Should we just say yes, just to be optimistic?
I get. Yeah.
By the end of this year, there's got to be a poly market.
You can be optimistic. There probably is a poly market. Well, I guess it is. It's kind of baked into. There probably is a poly market, and obviously there's a forward curve, as well, and it's not projecting 3.5%. We can want it, as in like the 10-year Treasury at 3.5% would make a lot of deals that don't work today. They would work all of a sudden.
What does it do for those maturities that we were just talking about? It's a little bit too late for that.
Well, that's the thing. There's a lot of. It probably is too late. But if we're moving in that direction, again, it's like sometimes you need is a little bit of hope.
Yeah.
And because right now the narrative is the 10-year Treasury is stagnant. It's kind of stuck 4.1, just north of 4. Yeah. It's stuck, and there's most projections are saying it's probably gonna stay there, and that's because I don't think there's really evidence for anyone. No one really knows. So it's just going to stay here. But again, moving it artificially, again in the short term, would be very stimulative. On a micro sense, good for businesses. But again, are there unintended consequences? Does that reignite inflationary pressures?
Sure.
But will we need to do that anyway? Because the economy is slowing down. If it's slowing down, a lot of economists say the economy is slowing down, combined with some deflationary impacts from AI and technology. And so, right now today, it seems like we're getting ahead of ourselves, and again, you might spark some additional inflation. But could it potentially be timed well? And again, it sounds like we're trading with the U.S. and global economy right now and timing the market. And if I've learned anything about investing, is humans were really not great at timing things. So it's a little scary to think about this. But I guess is there a case that it's the right move, that it's like a good trade to lower that 10-year Treasury just to get in front of a slowdown?
Could be. I mentioned my biggest concern was rising expenses, and so as you mentioned, the inflation and just kind of continued rising expenses as there's more money into the economy and the system, and money's more inexpensive. obviously leads to things becoming a little bit more expensive, but it also leads to opportunities. It's kind of a double-edged sword.
Yeah. What if, again, we'll go off on the deep end here. So we get all this Venezuelan oil.
Right. I was going to ask you about that. I didn't know if I didn't know if it's the right medium for that. But what do you think?
Anything's on the table.
All right,
In the Gray Report, Griffin. Well, so I mean, you've probably read similar articles that I've read, but
Yeah.
there's no like immediate term change to the price of oil from Venezuela. Like it's going to take years to be able to build up infrastructure to make any meaningful development. They're the largest resource of oil deposits in the world. In other natural resources. So, but I mean, theoretically, again, this is probably years in the making, but markets can start pricing this in at some point, just not now. But if we are able to unlock that much energy, theoretically, the price of energy and oil, goes down. And that's also deflationary, which is a good thing. The cost of goods the price can go down, or the rate of growth can slow down potentially. But it's way too early.
Too early
to know if anything. I mean, again, are we running the country, or are we not? Are we not running the country? I don't think. Somebody might. I don't think anybody knows.
Somebody knows, but also nobody knows. I always thought it was interesting. I read an article the other day that just was talking about the oil, the running of Venezuela, what's best for the United States and what's best for Venezuela, what's more mutually beneficial. And the long-term vantage point was to continue to invest in the infrastructure in Venezuela, become a very programmatic and favorable trade partner to the country, and such that they're no longer selling their oil to various countries that otherwise they were previously, but they're selling it to us, and we're helping them extract it and helping them build the infrastructure, investing back into Venezuela in exchange for this mutually beneficial trade partnership. Super too early to kind of know where it's going to go, but I thought it was an interesting perspective as opposed to just grabbing the barrels and run, which I think would be.
I don't think the barrels are there to say that we have to go build the retrofit the rigs that we built, or add new rigs and redo it and build up the infrastructure. But we do have the refining capacity, in the Gulf in the United States to be able to refine the heavy crude. But it is interesting. It's opening up new markets. I think that that is positive. Billy McFarland from the original the Fire Fest.
Didn't he just throw another party?
He threw another party. He's talking about potentially throwing a new festival down in some of the islands, Venezuelan islands, now that it's opened up. And I also started seeing content of some bill fishing maybe coming back, sport fishing back to Venezuela. Because the diaspora from Venezuela, I think 8 million Venezuelans, left out of a country of like 25 million. And so there's a lot of Venezuelans can repatriate, which bring this back to multifamily, that actually have a potential, negative effect on population growth, rent growth, and the reduced immigration so far this year has put downward pressure on rents, not as much pressure. And, there's a lot of Venezuelans that are in the United States that do want to come back. If they do start coming back, I think it's probably on the margins, but probably, again, just slower population growth generally leads to slower rent growth. And, population growth in the United States has been positive, primarily due to immigration. So as we have less immigration, we're much close to stagnating than growing.
Interesting times. It's year 2 of 4 in this current administration, and the first year was very eventful. Second year also has been very eventful.
Yeah,
we'll see how it goes and how it impacts the multifamily industry and commercial real estate.
Yeah, it's always fascinating, just how it affects risk markets, and as far away as it all seems, it all comes back. Well, let us know in the comments below. What you think about multifamily? Any predictions that you have for 2026? Your hopes, your fears? Are we going to see, the industry crash up against this wall of loan maturities? Is it still a nothing burger? Will we get the 10-year Treasury down to 3.5%? And the big question is, with both of those topics, are will inventory be unlocked? Is this a year where we can continue to do some really good deals, or is this just another year of just muddling through? Just the thick mud of uncertainty to get to the promised land, and with the reality that we may never get there, and it's those who can persist and stick it out are going to find the best opportunities when they emerge, because there will be incredible opportunities this year. There just might not be a lot of them, and it's those that are in the market ready to go. We're going to be able to take advantage of them. Those who have given up, sitting out on the sidelines, they're going to be looking back and saying, yeah, I wish I would have bought in 2026, but you missed out. Any closing thoughts, Griffin? Remarks?
Stop by next week on the YouTube channel. The mustache will still be here. And
See
we
how
appreciate
Griffin's doing. We'll have to measure it.
It's gonna be quite exposing, but all right, sounds good.
You mentioned it,
Right,
You
I
mentioned
did.
you told the world about your goal.
I did.
Of growing a mustache within just a couple weeks.
It's gonna happen.
It's happening.
It's a good look.
Yep.
I promise.
All right. Thanks for watching this episode of the Gray Report. Like, subscribe to the Gray Capital YouTube channel, and yeah, we'll see you next week.